Ladies and gentlemen, good afternoon. I'm here with Dave Stevens, former CEO of the MBA, and we're going to talk a little bit about some of the changes that have been occurring because of COVID and its effect on the economy. And Dave, we spoke a little bit about the economy transitioning from a you go to it type of approach, where you go out for entertainment, you go to sporting events, you go to restaurants, you go to see a mortgage originator, to the it comes to you under the COVID quarantine and so forth. Talk a little bit about what you see and how that might affect our industry.
Well, first, Jim, it's great to be with you always.
Thank you.
And I think the one thing that all of us are wondering is, will there be a new normal, which there will be once we get a vaccine, but to what extent will that impact the lifestyles we all just left? And most of American workforce was worked in an urban or near urban environment, office buildings and retail businesses that depended on the workers coming into those office buildings, and everything from Uber drivers to hotel chains also co-located, and that interdependence built the nation's greatest cities and theater and everything else, culture that came with it. And so we're here in an environment now where, we're seeing just the exact opposite. People have vacated cities. I spoke to, as you all know, we hold the MBA. MBA holds their secondary markets conference at the Marriott Marquis in New York, which is the biggest hotel in New York City. And I talked to a friend there who's a general manager I've gotten to know well over the years. I called him recently. I said, "How's it going, George?" And he said, "Dave, it's great to hear from you. It's going well for us, but we've had to lay off 80% of the workforce." That 80% of the workforce, and I'm not sure how many of you talked to the folks who clean your rooms at some of these big hotels, they're lifetime employees. They've worked there for their whole careers. It's not like, fly-by-night workforces that run these hotels, and they're typically renters because they're service employees. You have a higher preponderance of rental, and they're all out of work. And it doesn't stop there, but I think this is really a tale of winners and losers, have and has nots through this recession. As it relates to what we do and to workforce, we're clearly seeing the impact of that, right? We're seeing millennials who are renters in urban markets now wanting to move out to more suburban areas to take advantage of a yard and maybe some room. We're seeing extraordinary activity in the home purchase market, but not for condos. Condos are very soft right now in urban sectors. It's single family detached first time homeowners housing, which is at a terrible shortage where all the demand is. And at its extreme, and I'll just give you an example of a couple that we know from Alexandria. They're both fully employed through COVID, but with the remote workforce and communications with their companies, which are big national companies, saying that they may never actually need to come back to the office except on occasional meetings, et cetera. They actually sold their Alexandria home and have moved to Roanoke, Virginia. So we're seeing, that's a story I also read in Forbes, which is people are picking up and moving to second tier cities and those areas because housing is cheaper, the lifestyle is more affordable. And why not? Because you can work from a remote distance. So the only question I have, honestly, and I'm a kid who was born in New York City, is does it stay that way? I mean, my wife and I are chomping at the bit to get back to New York. I love New York, and I love the vibrance and the theater and the restaurants and all that. Is that ever going to come back? And I don't think anybody really has that answer, but I do know, and I'll stop here. I do know, based on the folks that I advise and consult for, a lot of them are looking at perhaps permanently keeping a bunch of their offices closed.
So in the residential mortgage banking space, it's been going great guns. On the commercial real estate mortgage banking space, it's a different story, I guess, based upon some of the things you just mentioned.
Right. Yeah. And look, there's plenty of analysis. All I'm doing, Jim, and in all honesty, is sharing the research that I'm getting every day in my inbox. One of the benefits of working for a president and running the MBA is I continue to get great information. And we know we're in a very awkward place as of this discussion. We don't have a CARES Act, a HEROES Act, which is the follow-up to the CARES Act. And as a result, the compounding effect of vacancies in commercial office space in urban markets, the failure of retail stores and shops, which often occupy the first floors of these commercial properties, all the loss of rental income, and more is a big threat to the commercial market. And now we're seeing really extraordinary concerns over now another round of what could be pretty significant layoffs heading into the winter, especially without a HEROES Act. We're obviously hearing it from the airline industry. The biggest movie theater chain in America shut down just altogether. We could go story after story of where that's happening. And so there's extraordinary concern amongst in the commercial space, particularly around owners and owner operators and managers of commercial property about being able to even keep a break-even business model given all that's going on. What adds the compounding effect here, as you know, is many companies are on long-term leases, and if they're large nationals, they can continue to make those payments. But many of these long-term leases are held by companies that are also threatened, especially if this stays in a prolonged state until perhaps next spring without a second round of legislated intervention. As we talk today, you and I are both well aware that the President Trump made some awkward statements about a second round of legislation, and that caused a significant impact to the stock market. And for that's that moment in time. Now, what happens from the time we're talking today going forward is yet to be known. But in the end of the day, and please excuse the sounds in the back. This is doing Zoom from COVID homes. It is a really great concern. And I will tell you this: every company that I'm consulting with, as I said earlier, I was on an operations call today with a company I'm an advisor to, and they were talking about lease expirations and permanently shutting down offices and shrinking down to a smaller space and keeping the branches and their people working remote permanently. That's just one microcosm example of something that's likely to play out over time. And I want to reiterate, Jim, to the point, this whole broad point. My office is in DC that I left when I left the MBA. The restaurant on the main floor, the dry cleaner across the street, the restaurant where everybody had meetings when people were coming into town, the one hotel or two hotels we used that were close enough to walking distance to get to, they're all in terrible situation. And and I think it's just a matter of time before we start seeing dominoes really fall, which is why, economists like Mark Zandi, like Fed Chairman Powell and others have been arguing that we need broad legislated intervention to maintain economic stability through what's going to be an extended period here before we get a vaccine and even consider whether we're going back to work or not, because this is just a double whammy on an awfully terrible situation.
Yeah, many friends I have in the restaurant or the hospitality business are just suffering immensely. And you look at the stock market and it's back to where it was, but the service business, the hospitality business, the transportation business, there's just a lot of pain there. And I agree, we have got to find a way to bridge that on an interim basis, despite the political debacle that's in Washington. One of the things you mentioned about...
I was just going to say, keep in mind, Jim, that if you live in a suburban area, restaurants and in general, as an example, are actually faring much better. Takeout and delivery are allowing them to get through. In urban markets where people only tend to go into work Monday through Friday, yes, obviously a lot of people live there as well, but they probably double or triple their traffic activity from commuters who commute in for work. they're getting slammed. So it also is dependent on where you live and where you work.
Well, and as you, I love New York and think of all the restaurants that I visited over time and love to visit. And I fear that many of them will have a really difficult time sustaining themselves simply because you can't make it work on 25% or outdoor dining.
Right.
You mentioned some of the offices and some of the clients that you work with, as well as the folks that I've working with. The technological shift of being able to work remotely has gone, by most means, remarkably well for the mortgage banking business. And at the same time, you have Intercontinental Exchange kind of making a big investment in an LOS provider. You had some legislative aspects at the local and state level, kind of making it easier to do e-mortgage. Could you kind of give us your view on what the technological landscape may look like, whether it's going to accelerate, what you see kind of happening in the whole digitalization of the mortgage banking business, and then working on the cost structure in the mortgage banking business?
Yeah, so I always tend to anger my friends who are loan officers and somehow think that their paradigm is going to remain the same indefinitely, and that their value is going to always demand that they be part of the process and earn their, whatever 100 basis points or plus or minus of income that they make on each transaction. I actually look at the world in a very different way in terms of where this is headed. And you and I both go back in time when, the MLS book was a book and you needed a realtor to find out what was on the market. Today, you can look on Zillow or realtor.com or whatever the various internet providers are. As a consumer, at least know what inventory is out there. You still need a realtor to show you the home, and only a realtor can tell you, quite frankly, things that whether they should or should not tell you. They can tell you about the schools. They can tell you if it's a level lot or railroad tracks are behind it, or what the story is and why it's been on the market for so long. So that does require some help and some handling. Mortgages are a commodity. Back in our day, we had variable rate loans, ARMs, graduated payment loans, different indexes. Everything was esoteric. The dominance of Fannie and Freddie wasn't anywhere near as big in the 80s as it is today. S&Ls and banks had their own proprietary products. And so there was friction and complication, and there wasn't an internet or an easy form of communication to help people understand what these products were. Today, in a post-Dodd-Frank housing crisis America, we are in a very commoditized product set where everything's the same. Everything goes through Fannie, Freddie, or Ginnie, with rare exception. And even if it is an exception, like a jumbo loan, much of the underwriting guidelines and product parameters look almost identical to what Freddie, Fannie, and Ginnie are offering. 30-year, 15-year, 20-year, 10-year, same index, very comparable sort of structure. So I contend that, getting a mortgage loan going forward is going to be about as complex as it is to get a credit card. Unless something changes that paradigm. I'm not sure why you need loan officers to handhold someone and point them to the website. I think this whole question of value is something that I think our industry, at least the production side of our industry, is playing ignorance to. The reality, in my perspective, is, and I've gone through a refinance recently, working with one of my favorite loan officers who just pointed me to their website to fill out the app. And I was like, well, I really don't need you. I've worked in this business for decades and started as a loan rep, but ran many large production shops. And I can tell you, behind closed doors, leadership always talks about the extraordinary cost of the production side of the business. And if they could, they'd find a way to reduce that expense. And so I think we're getting to a place where Ubering or Amazoning the mortgage industry is something that we're literally on the threshold of seeing come to play. In fact, Quicken is the first big IPO and the biggest IPO ever in our business. And they're built on a consumer direct centralized platform. It's not all they do, but that really is the structure of Rocket Mortgage. And my own sense of this is even they might be a little before their time. In other words, I think they're going to be even more modernized solutions for consumers to come into market. You mentioned ICE, Intercontinental Exchange. I had an opportunity to work very closely with them because I was on the board of MERS when MERS was sold to ICE. And I was very much engaged in that process, both in conversations with the team under Jeff Spraker at ICE and our board members. And at the MBA, we were one of the biggest shareholders, so we were principal to that decision to ultimately agree to the sale. And I can tell you that all of us involved in the process knew exactly in our own mind what ICE was doing. We saw a vision, which is control the data that flows through the mortgage system. And if you can get enough access to that data, you can provide your technology solutions to provide extraordinary efficiency. Now, I don't know what ICE's next step is, but they've, their most recent purchase is certainly telling. And they already own the biggest stock exchanges and biggest exchanges in the market. They're clearly putting themselves in the middle of however that borrower ultimately communicates to the investor. And my sense of this is that's going to lead to groundbreaking new business developments that frankly can make it easier. And the last point I would just make, I'm sorry to always be so long in these answers, is the thing that I don't think we all realize, many of us because of our age, is that, millennial generation doesn't even like to talk on the phone. I mean, my kids who are all millennials, they'll text me. They don't even use Facebook. They'll text me preferred all the time. They never answer the cell phone when I call them. I'm not giving you the woes of a parent. I just think this is their preferred form of communication is via technology. When they have a problem with a product, which they've already ordered online, I don't see them ever calling customer service or emailing or texting, getting on screen with them to solve the problem. When I'm the guy who I'm a pick up the phone guy, but I really think I'm the dinosaur in this process. I think the transformative scenario we see is a younger, more diverse borrower population, much more comfortable, in fact, overly comfortable with technology, not needing their hand held by some individual loan officer at some company going forward. And as realtors get younger, new realtors coming into the space, they'll feel less concerned about controlling the process with their preferred loan officer, which is one of the advantages LOs get today, is that relationship and that referral, as they call them referral partners, is much more important. I see going forward, and I meet them all the time, dynamic young real estate agents who are fine just delivering someone online. They wouldn't have to be in the same state, in the same market. They could be anywhere around the country. Frankly, I think they could be anywhere around the world and provide the same service. Because again, rate, points, term. It just isn't that complicated as we go forward. And the last technologies that a company like ICE could create is being able to tie into the ADPs, the IRS databases, and more to finally solve that solution gap that still doesn't exist today, which is getting those data elements that you need to truly create end-to-end process efficiencies that would significantly reduce the need for any human intervention on mass scale. We have an appraisal to worry about. We have counter recorders to worry about. We all know the issues that are stumbling blocks to creating a really perfect end-to-end solution, but we're getting a heck of a lot closer. And I don't think that's going to stop. And I think ultimately the cost of hiring a loan officer to do your mortgage will likely come down pretty significantly. And not tomorrow, but over time.
Well, I was talking with Chris XD of ICE a little while ago. Yeah. His reminder to me was that before the abolition of fixed commissions in the retail brokerage space, it cost $350 to trade 100 shares of IBM. Today, it costs less than 3 cents.
That's a great example. Yeah.
So it didn't replace stockbrokers per se. Their jobs changed into a much more of an advisory role, handling much larger portfolios, much fewer transaction elements, because the consumer just trades on their own. or
That's right.
uses an alternate vehicle like a mutual fund or an ETF. So it's interesting that there also, ICE is a non-mortgage player coming into the space, and that kind of is an interesting opportunity for them to question the whole, well, why do we do it this way? And then lastly, just the ability of them to run a market and potentially to take some of the friction out of the securitization business or the whole loan business, I think is pretty amazing. So we're in exciting times, and Dave, really appreciate you taking a few moments and spending some time. It's always a pleasure to talk. I really appreciate your perspective and really appreciate your leadership and courage leading the industry through some of the most difficult times, and really look forward to staying connected. So thank you so much.